Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
$14.90 WGCH. This is Carrie Lutz. You're listening to the Financial Survival Network. Back for his weekly rant is Ranting Andy Hoffman, and gold has just broken through its 200-day moving average on the upside as per expectations. Andy, what did you think about that?
Well, as far as expectations, I tend to try to be bigger picture because especially with manipulated markets and all the fast pace of news, I try not to get involved with short-term movements. But gold is only traded below its 200-day moving average, maybe 10% of the time over the last 11 years, and it's only traded 5% below its 200-day moving average 5% of the time, and most of that was in 2008. So it's a no-brainer in a bull market to buy dips like that. Not to trade per se, but for people who are buying new positions or adding to current positions. I think that's those long-term technicals are very important to look at. Not short-term because they're rigged, but the long-term. What I found is that the long-term technicals are actually more powerful in gold than any other business because all the rigging, all the capping creates these huge resistance levels, and when they're finally broken, they are very, very difficult to penetrate on the downside.
Yeah, it's kind of like when you were a kid and you had a jack in the box, and you'd be turning the handle and holding the lid down, and then the spring would build up such pressure, and you'd let your hand off the jack in the box, and boom, man, he would shoot up into the air, and that's kind of what happens because they can't change the underlying trend, right? The underlying trend's the underlying trend.
Yeah, a perfect example is the $20 level on silver. I mean, because look, I write about this stuff every day about key round numbers. I talk about key attack times, key round numbers, because it's psychological operations. In fact, I was just writing a piece for tomorrow about those operations. And silver first touched $20 an ounce. It was in March of 2008. I remember it. I was at the PDAC conference in Toronto, and it proceeded to be attacked. And finally, it got back up after the meltdown in '08, back there in mid-'09, and it spent a whole year fighting for the $20 level. And finally, when it broke out in the summer of 2010, it went right to 50. And after that, now we're talking about 8 or 9 months ago, we had the Sunday Night Massacre. We had all these attacks in the fall. I call them Operation PM Annihilation 1 and 2. And if you look at the long-term chart of silver, you'll see that $30 level is where everything has been based around. And we've now built what I think is a massive support level at the key $30 level. And as a result, I think the next move is going to be to go for the ultimate resistance level, the big triple top breakout that's coming at $50 sometime in the next few months, hopefully.
Yeah, I see the same in gold. Gold, they got it down to what was the low, 1520?
1520. Mm-hmm.
Yeah, and there was no fundamental reason for it to go there, and that's what people, when you watch markets day to day and you're not a professional and you don't have the right perspective, they totally deceive you. When you view it from a longer trend perspective, they make total sense. And that's why amateurs, and I consider myself an amateur, should not trade, because emotions invariably take control and you wind up doing exactly the wrong thing at the wrong moment, which is why having that physical in your hand, for one thing, it's a real pain to get rid of it. You have it locked away someplace, buried in an old mine shaft in the Adirondacks, wherever it is. It's not in your hands, so you can't freak out. And then you get home after the price went down and you say, just leave it there. And that's what's so important about physical ownership, is that it takes the emotions out of it all.
Yeah, and it took me 10 years of, constantly changing market conditions, among other things, and changing a manipulation, and understanding why I owned gold. I used to own it more as much offensively, like it was a tech thing, like to make a lot of money, as I did defensively. Now I realize gold is money. I own it entirely to protect myself. There's a dual positive in that it will make you more money per se than any other, than most other stocks in history. And again, you should never be playing with the paper stuff because that's pure speculation. It's also a rigged market, both on the upside and downside. You're not going to make money that way. And you're talking about the resistance and support levels with gold. The key number now to me, and I've been writing about this forever, and you'll see it in tomorrow's piece. I brought it up again, is this 1750 key price level. That's the level that in early December, gold tried to get over 23 times in, I think, a 7-day span. And finally, when it finally broke, the cartel put out that headline that the Fed was selling gold, and then they retracted it. And since then, it plummeted, and here we are again fighting at 1750. And I believe that this is the point where the massive resistance is being built by them, and it's going to break, and it's going to become support. And when it does, then you're going to see the real key number of 2,000 come into play, and that's when the psychological change around the world is going to happen.
There's a certain feeling of inevitability about the whole thing. Like, you just know it's going to happen, and people will listen and say, oh, you're gold bugs and it's a bubble, blah blah blah. But the fundamental story, the fundamental picture is so overwhelming and so powerful and so intractable and insoluble that that's why it's going up. Forget about the blips. Yeah, technically 1750 is the line in the sand, but they've had other lines in the sand and they've all been crossed. So my point is, there's an inevitability to this whole sense of where these markets are heading, right?
Absolutely. And there was inevitability in 2002 when I started, in 2005, 2010, you name it. It's going to keep going up. I say these numbers, 1750 or $30 in silver, simply because I've kind of become a cartel watcher. I know what they're doing more than just about anyone. I know that $30 at silver has been an incredibly important number for them because it's a very key psychological number, just like I know that $2,000 is. And clearly by their actions, I could see that they believe 1750 is the point where all of a sudden that 2,000 will come into play, and that's why they're fighting it. But like you said, it always goes through. It'll go through 1750. They'll put up a line at 1800. It'll go through that. They'll put up another line. And then the next thing you know, it'll be 2500. And there won't be any supply left. And people have to realize, again, gold is money. It's not an investment. Like you said, you put it away, and then you wake up and it's worth more.
Yep. It's a Gresham's law, which is gold is the good money. It's been forced out by the bad money, the paper. But when the paper starts becoming worth less and less, then the good money is going to start coming out because people aren't going to take the bad money because they're going to lose confidence in it. And that's the process that's underway. And that's what I saw. I felt a seminal shift when we talked last Wednesday, that the confidence game had been broken and that now it's really just a matter of time, that the word is out. You're going to start seeing companies with huge cash hoards picking up on metals for very innocuous reasons. They're never going to say why, but you're going to see mainstream investors, and the corporations got trillions of dollars in cash, gravitating towards it for whatever reason that they say. It's inevitable. There's no question.
Yeah, well, I mean, when the Fed says things, okay, they do things very calculated. I mean, yes, they do plenty of stuff covertly behind the scenes, probably as much as they do overtly. But the fact is, every word that they say when they put out a statement is carefully discussed. In fact, Jim Rickards, I've quoted this many times. He has a friend who used to be a Fed governor, and he said, all we do in those 2 days is figure out what to say and how to say it to fool people, to make people think that what we want them to think is what's actually happening. And believe me, it was only August, 5 months ago, when they changed from we're going to keep interest rates low for an indefinite period of time to mid-2013. And it took 5 months for them to go mid-13 to at least the end of 2014. And I can assure you that they are very, very cognizant of why they said that. And it's because they are telling you we are going to be printing money ad infinitum. It's 3 years at least. And be ready for it.
Yep, it's QE to infinity. There's nothing that's going to change that. That's what the people in the know have been saying since the early 2000s. And there's nothing that's happened in the world to make us think otherwise. But I think a key confidence indicator got broken last week, and it's not going to get fixed until this thing plays out.
Well, not that I had any confidence, and frankly, I don't know who else had confidence. But you know, I mean, when you have the night before, when you have the president on Tuesday night saying the economy is doing great, and then on Wednesday morning the Fed saying no, it's not, you could tell that at the least there's a very bad lack of communication between the top that exposes how little they actually know what's going on. Yeah,
well, you know, the party line has been, we've been in this recovery for 4 years now, right? It's 4 years, just about 4 years. And I have yet to witness it. And from what you said, I don't think you're seeing it either. Yeah, New York's not as bad as the rest of the country yet because the Wall Street money flows and the deficit's like the best thing ever for Wall Street. It's just a license to print money. But this isn't an economy that's strengthening. Jobs are not increasing. Wealth is not being created. That's the problem with GDP. It isn't a wealth creation indicator.
Yeah, the Baltic Index, for listeners who don't know what that is, it's the most widely watched gauge of international shipping activity. It's kind of an index of that's based on the prices of shipping. Now, several things can impact it, such as if they build too many ships or all kinds of other things. Specific markets may impact it. But the fact is, it has now fallen all the way to the levels of the bottom 3 years ago. And there's a chart in that I found on Zero Hedge today. I'll put it in my piece tomorrow. It's showing that it's basically at the 25-year low, which is pretty remarkable given how much inflation we've had in 25 years. So, and then, you know, there's also some charts out there today about the unemployment rates in Europe because, you know, they put out the real unemployment rates and they are staggering and getting worse. And half of all the shipping, goods in the world go through Europe in one way, shape, or form.
Of course, they have to because they go through the Bosporus there. And if you've ever been to Turkey, it's a cool thing to watch. So are you implying, Andy, that the federal government isn't putting out honest unemployment numbers? Would they do that?
You said you gave me a good softball question last week. I mean, it's really staggering. It's staggering to watch, for instance, the European markets all crashing today, and then the Dow all of a sudden, Hail Marying like it does every day. It's the same thing with the data. They put out real data. We put out data which is so unbelievable. It's almost like I don't even watch the news. I watch Jon Stewart. That's the news. And if you want to watch statistics, go to Shadow Stats with John Williams because, I mean, people took apart that GDP report on Friday in 2 seconds. It was so comical.
Yeah, it was trash. And if you're understating the inflation rate, then you're overstating GDP. Not that GDP is a measure of economic health, because it isn't. It's just a measure of consumption when you get down to it, which is the opposite of economic health. But, hey, I think the Giants have a lot better chance of winning the Super Bowl than Ben Bernanke and our so-called president have of resuscitating this economy, don't you?
And if they do, that's a bad omen for the economy, according to that indicator of the NFC versus AFC. So I don't know what to expect. But then again, it's all set in stone anyway. If the football outcome is based on the economy, then the Giants are definitely going to
win. Yeah, well, that was that old stock market indicator with the long skirts and the short skirts. And,
right.
It's I don't know that it's necessarily predictive, but I actually got an invitation to go to the Super Bowl, to fly out of Westchester Airport, go there for the day, and then come back, not have to stay in Indianapolis, which Indianapolis is okay. I've been there a couple times. But I couldn't do it because I'm off to Freedom Fest later this week in the Bahamas, and I don't get back till Sunday afternoon, so I got totally bummed. But what can you do? Work's got to come first.
Yeah, you have to go to the Bahamas, sorry.
Yeah, it's tough, man. I mean, I'm really going to be upset when I'm in the sun getting tan and on that jet ski, you know? But what could you do? So I'll watch it on TV. But the other cool thing is to go to Vegas and hang out for a Super Bowl party at one of the big casinos. Those go wild. But anyway, and thanks for being on again. We will catch up with you next week. And, you know, as you said, don't pay attention to the short-term blips. Leave that for the professionals like you, and just buy the stuff, bury it someplace, and just leave it there and come back and get it when you need it.
Hey, no one's a professional in a rigged market. I'm a professional in the market for real money, not in investments.
Hey, amen to that. You called it exactly right, because unless you're an insider, you don't really know what they're going to do next. You can only see what they've done.
Mm-hmm.
All right, and so next week we'll pick up and go Giants.
Absolutely. Have a good one.
All right. Be well.